The UK gives you £20,000 every year completely tax-free, but most people use it in a way that quietly keeps them poor. In the next few minutes, you'll see exactly which ISA actually builds real wealth and which one only feels safe. An ISA, or individual savings account, is one of the most powerful financial tools available in the UK, but most people misunderstand how it actually works. At its core, an ISA is not an investment. It's a wrapper. Think of it as a protective container that shields your money from tax. Whatever happens inside that wrapper, whether your money earns interest, grows through investments, or generates dividends, you keep 100% of it. No income tax, no capital gains tax, nothing owed to the government. Every UK adult gets an ISA allowance of £20,000 each tax year. That means you can deposit up to £20,000 into one or multiple ISAs annually, and once the tax year ends, that allowance is gone forever. It doesn't roll over. It resets every April. So if you don't use it, you lose it permanently. The key distinction is this: the ISA itself doesn't determine your returns. What you hold inside it does. You could hold cash earning interest, or you could hold investments that grow over time. Both sit inside the same tax-free wrapper, but the outcomes are completely different. This is where most people go wrong. They focus on opening an ISA, but not on what they actually put inside it. A cash ISA is the simplest and safest version of an ISA. It works almost exactly like a traditional savings account, except any interest you earn is completely tax-free. You deposit your money, the bank pays you interest, and your original amount is protected. There's no volatility, no market swings, and no risk to your capital. For many people, this feels comfortable, and that's exactly why it's so popular. As of 2026, competitive cash ISAs are offering around 4% to 5% AER. On the surface, that seems solid. For example, if you deposit £20,000 at 4.5%, you'll earn about £900 in the first year. Over time, that interest compounds, and after 10 years, you might have around £31,000. That sounds like steady growth. But here's the reality most people ignore. Inflation quietly erodes your purchasing power. If inflation averages around 3%, your real return is only about 1.5%. That means your money is growing, but very slowly in real terms. You're not actually building significant wealth. You're just preserving value. Cash ISAs are useful for short-term goals, any emergency funds, or money you'll need soon. But relying on them long-term is where the mistake happens. They protect your money, but they don't meaningfully grow it. A stocks and shares ISA uses the same tax-free structure, but instead of holding cash, your money is invested in the market. This means you can own assets like ETFs, index funds, individual shares, or bonds. Unlike a cash ISA, your returns are not fixed. They fluctuate based on market performance. An ETF, for example, allows you to invest in hundreds or even thousands of companies in a single purchase. This gives you instant diversification, reducing the risk of relying on one company. Historically, global stock markets have delivered average returns of around 7% to 10% per year over the long term. Using the same £20,000 example, the difference becomes clear. At 7%, and your investment could grow to roughly £39,000 in 10 years, £77,000 in 20 years, and over £150,000 in 30 years. That growth comes from compounding, where your returns start generating their own returns over time. However, This comes with volatility. Some years, your portfolio may drop by 10%, 15%, or even more. That's normal. The key advantage is time. Over longer periods, markets have historically recovered and continued to grow. Investors who stay consistent and avoid panic tend to significantly outperform those who stay in cash. This is where real wealth is built. Now compare both side by side using the exact same starting point. £20,000 over 20 years. In a cash ISA earning around 4.5%, your money grows to approximately £49,000. It's stable, predictable, and safe. You always know what you're getting, and there's no risk of losing your original investment. In a stocks and shares ISA, assuming a conservative 7% return, that same £20,000 grows to around £77,000. That's a difference of £28,000 from the same starting amount over the same time period, simply because of how the money was used. This gap exists because of compounding and higher long-term returns. The longer your time horizon, the wider that gap becomes. Over 30 years, the difference becomes even more dramatic. Of course, the stock market doesn't guarantee returns. There will be periods of decline and uncertainty. But historically, time in the market has consistently beaten holding cash for long-term growth. The real takeaway is simple. The ISA wrapper gives you tax efficiency, but the investment choice determines your outcome. Safety has a cost, and in this case, that cost is lost growth over time. Choosing between a cash ISA and a stocks and shares ISA comes down to one thing: your time horizon. If you need the money within 3 years, a cash ISA is the safer choice. It protects your capital and avoids short-term market risk, making it ideal for emergencies or planned expenses. If your timeline is 5 years or more, a stocks and shares ISA becomes the better option. It allows your money to grow through compounding and recover from market dips over time. If you're unsure, you can split your ISA, keep some in cash for stability, and invest the rest for growth. Platforms like Trading 212, Vanguard, and Invest Engine make it simple to start. The key is consistency. Even small, regular investments build momentum and lead to meaningful long-term growth. And if you haven't used your ISA allowance this year, act now. Even a small start puts you ahead of most people. Subscribe now, build wealth smarter, and grow your future consistently.